Most traders struggle to make $500 in a week, but I've been able to make well over $50,000 in the past 2 days trading a very simple strategy on gold. And the crazy part, I didn't even have to over leverage or risk more than usual. I just copied the same exact setups and trades across multiple Apex accounts. Let me show you exactly how I did it. Okay, so before we go ahead and get started, I just wanted to show you guys that I do have 20 Apex PA accounts. You can see here, today I made $20,000, $1,000 across all 20 of my accounts. Over the past week, I have strictly decided to only trade gold. Now, the reason behind this is because whenever we are at all-time highs on NQ, which is NASDAQ, the market conditions become unfavorable. It's very difficult to trade at all-time highs. And although gold is also at all-time highs, I'm able to use a few different confluences with other correlated assets that aid me in being able to trade gold while also being at all-time highs. So before we go ahead and get started, I want you guys to make sure that you have a few things in your watch list. The first is obviously going to be gold, okay? The next thing is going to be the US dollar index, or the DXY. Now, the reason why we are going to have the DXY is because it is inversely correlated to gold. That means that when we expect gold to move higher, that means that DXY in theory should now be moving lower. Now, the next correlated asset that I use is the Euro USD. Now, although Euro USD is not directly correlated to gold, it is inversely correlated to the DXY, similar to how gold's relationship with DXY is. Now, the reason why I use the Euro USD is simply for overall directional bias, because in theory, if Euro USD is pushing up, that means that gold should also be pushing up, and that means that the DXY should now be pushing down. So I'm not really using this on a candlestick by candlestick basis. However, I am using this for overall narrative when it comes to my daily bias. Okay, so here I have the gold chart outlined. The first thing I do when I get onto my charts is that I load up this indicator. If you go over to indicators, you can see it is referred to as market profile at Josh Shu. Now, before I started using this indicator, I used to manually place vertical lines across my chart to indicate the separate days. However, I found it easier to simply just use this indicator that will do it for me. Not only that, but this indicator also outlines the different sessions, Asia, London, New York AM, and New York PM, as well as previous day low, high, and New York midnight open. These are all important data points that we should all have on our charts, and this indicator makes it a lot easier. Okay, so the first trade that I took this week was actually on Tuesday. On Tuesday, I needed to identify the dealing range that we were currently trading within. On Monday, we had a very large range push up. And then during London session on Tuesday, we aggressively displaced to the downside, moving from an area of premium into an area of discount. Now, if we take this most recent low and mark it out to this most recent high, you can see that the 50% of the dealing range rested right here. Whenever price is in the premium of the range, I always expect it to come down into the discount of the range and take out some sort of internal range liquidity. You can see right here that price took out this internal range liquidity before then pushing up. If I go ahead and cut my price here and we kind of zoom down into the 15-minute time frame, you will be able to see that right here, price swept this internal range liquidity towards the end of London session on Tuesday, September 30th, 2025. Right as price swept this area in price, we failed to continue lower. You can see price pushes up into here, into this fair value gap, and then we come down and fail to create a new low. Whenever you see a failure swing low, this indicates that price is likely going to reverse. Now, you can see here, right as price has this failure swing low, we now push above this old high, creating a higher high right here. Immediately after creating this higher high, price trades back down into this order block, and now we've placed in a higher low. Whenever we are in bullish order flow, you want to see higher highs and higher lows. You want to see down close candles supporting price, and that is clearly what is happening right here. Because this fair value gap got disrespected, it now becomes an inversion fair value gap on the 15-minute time frame. With that in mind, I am now expecting price to no longer want to violate this fair value gap anymore. We've already pushed through it, so I'm expecting it to support price to the upside. Right as I saw this displacement through these down close candles, we had a change in the state of delivery. A change in the state of delivery represents price changing its delivery of liquidity. So before, we were seeking sell side. We took out sell side here. We failed to continue to take out sell side here. Now, right as price displaces above the opening price of the highest down close candle in the swing point that took out that liquidity, the market is now indicating to us that we are going to be seeking buy side. Okay, delivery is now in line with higher prices. So with that in mind, I know that down close candles are going to be supporting price, just as I previously mentioned. So I outlined these two consecutive down close candles on the 15-minute time frame. Right as I saw this candle come down and rebalance this displacement leg, I dropped down into my lower time frame. On the 5-minute chart, you can clearly see that this low right here was simply a sweep of liquidity. Right after sweeping, we displaced up, and then we started to trade back down into this order block right here on the 5-minute. Now, if I were to take this order block and I were to measure out the 50% of the range, you will see how the bodies of the candle were respecting the 50%. Now, whenever I don't see a fair value gap paired with an order block, I always expect the 50% of that order block to get tapped before we then continue in the intended direction. With that in mind, I entered right here with my stop loss beneath the body of the order block, and I targeted all the way up here. I entered with one contract across all of my accounts, or 10 micros across all 20 of my accounts, risking $340 per account. And I targeted around 16.5 points, 165 ticks, for a total of around $1,600 to $1,700 per account, which is a total of $32,000 on my first trade of the week. Ultimately, price did end up shooting far beyond my exit. However, one thing to realize, especially when you're trading on a firm such as Apex that has an intraday trailing drawdown, is that you do not need to hold your trades too long, especially when you first get your accounts. It's extremely important to secure your profits as fast as possible, because something as simple as a retracement might be a detriment to your account. Because, for example, if I was up $1,600 and price were to come back down here, and God forbid I get stopped out at break even, I'm now out of $1,600 of that drawdown, because my drawdown has moved up $1,600, and because it is now retraced back against me and stopped me out at break even, I have now lost $1,600 out of my drawdown. And I am trading on $50,000 accounts, so that initial drawdown is $2,500 per account. So you have to be extremely careful whenever you are trading on a firm with an intraday trailing drawdown. One tip that I always recommend is that you trail your stop loss aggressively, especially when price is moving close to your target. Now, how was I able to determine this as my exit point? I simply took my fib from this high down to this low, and I measured out the 50% of the range. Anytime you enter into a trade, the safest exit point is always going to be at the 50% of the dealing range that we are currently trading within. Now, unfortunately, in this current swing, price never reached the 50%. But right as I saw price sweep the high of this 5-minute candle and then fail to continue to displace up higher, I knew that we were going to have a retracement, especially when I dropped down into my 1-minute chart. I noticed that we were starting to chop up here, and that is when I decided to fully collapse my position and secure my profits, and then I simply just walked away. The biggest issue that I see traders have is that they don't walk away whenever they are up, and they don't walk away whenever they are down. This is extremely important to master if you actually want to become a consistently profitable trader. You need to be able to maximize your wins and minimize your losses. For example, one rule of thumb that I keep in mind and I always teach my students is to simply walk away after taking 2 losses in a day. If I win my first trade on a given day, I will typically walk away unless I made a significant amount of profits, where then I may end up risking some of my profits to make a little bit more, assuming that there is an A+ setup that is forming. Now, one thing that I like to do whenever it comes to a funded account to allow me to manage my risk is to think of my account in terms of how many trades can I take before I blow my account. So for example, on my $50,000 Apex accounts, I have a drawdown of $2,500 when I initially start my accounts. That means that if I were to risk $500 in one trade across 5 trades, that would blow my account, assuming that I lose all of my trades. And 5 trades is not a lot. So whenever I am trading on a funded account, I like to give myself anywhere from 10 to 20 trades before I end up blowing that total drawdown on that account, because it's very unlikely that I'm going to take 10 losing trades in a row if I'm actually following my plan and if I'm actually following my system. With that in mind, I'm willing to risk anywhere from $150 upwards of maybe $350. In this specific trade right here, I was risking $340 simply because the trade was an A+ setup. So I was willing to take that extra risk at hand. Okay, so moving into the trade that I took today. Today is currently October 2nd, 2025. And this trade I made $20,000 on. It was very, very simple and basic. Upon getting onto my charts, I noticed that we had swept the previous day's low during Asia session right here, and then we displaced upwards above this down close candle, giving us a 1 hour change in the state of delivery, forming this as an order block. You can see here that price then came down. We respected this down close candle. Again, whenever we are expecting bullish order flow, you want to see down close candles supporting price. I then outlined the previous day's high because that was our closest draw on liquidity. Now, I typically get onto my charts whenever I am trading gold around 7:30 a.m., sometimes a little bit earlier, around 7 o'clock a.m. Eastern Standard Time. Today, I got onto my charts around 8 o'clock. Right at 8 o'clock, I noticed that we were reacting off of this wick that was formed yesterday from the news release that came out. Now, although we had a rejection off of this wick, I did not want to see price push all the way down. I outlined this order block and I wanted to see it hold. Now, again, I'm going to repeat this for the 3rd or 4th time. Whenever we are in bullish order flow, I want to see down close candles supporting price. Right as I saw us get a rejection out of this order block, I dropped down into my 5-minute time frame. Once I saw price sweep liquidity right here, I took my fib from this low to this high because this was the new internal range that had been created. And I simply waited for price to push down beneath the 50% of the range. Now, one thing that I heavily emphasize that you keep in mind is that you don't want to trade on candles that are forming. You want to wait until they close. If you would have entered as this candle was coming into this fair value gap, you would have been stopped out if you had your stop loss right here. Now, if you had your stop loss right here, you would have been fine, but this would have just ruined your risk to reward. One thing that I always do is that I just wait for candles to close, whether that's inside of the fair value gap or outside of it, depending on how we react off of that fair value gap. Now, in this given example, the fair value gap was actually more so in the premium of the range. I wanted to see price come back down a little bit deeper. And these wicks right here represent a rejection block. We also have this order block down here. So I wanted to see price come all the way down into the discount of the range. Once I saw price sweep this candle right here and start to displace upwards, that is when I decided to enter my trade. I entered on this candle right here and I had my stop loss right beneath this sweep. And I was simply targeting this high. You can see here off the 5-minute chart, price beautifully delivered up to the buy side after sweeping internal range liquidity right here. And then we pushed up to external. We went from internal range liquidity to external range liquidity up here. I'll drop down into the 1 minute time frame. As soon as price pushed up above this fair value gap that I had outlined on the 5 minute, I then began to trail my stop loss. So my original stop loss was right here. Right as we pushed up above this high, I then reduced my risk and put my stop loss here. And then once price pushed up above this high, I then moved my stop loss right here. And then ultimately, once I saw price push up above here, my last trailing stop was placed right here until we eventually ended up hitting my target, and I closed out for a total of $1,000 across all of my accounts for a total of $20,000 on this trade. That put me slightly above $50,000 in the past 2 days. Trading doesn't have to be as complicated as you think it is. If you have a proven system, you have good risk management, and you simply just allow time to do its thing, and you have patience, you will become successful. We are in Q4 now. We have officially entered the last quarter of the year, and I am personally taking on 5 hungry individuals that want to change their life, that want to escape the 9-to-5 job. Again, I'm only willing to work with the most serious individuals. And just as a disclaimer, there is going to be a 4-figure investment that you need to put up in order to work with me. Now, what we can do is go ahead and click the link down below in the description. If you want to learn how you can leverage copy trading, you want to learn how you can make your first $10, $15, $20,000 a month, all from trading, go ahead, apply down below, and I'll see if I can work with you. I'll go through your application and I'll send you a DM and I'll reach out to you. That is going to be a conclusion for the video. I hope you learned something new, and I hope you can apply something that I learned today in your own trading. I will see you in the next video. Peace.